Introduction. In 1999, when we began to write the first edition of this book, value investing as conceived by Benjamin Graham and David Dodd and developed by their successors was in eclipse as a method of stock selection. Academic finance had for 30 years embraced the efficient markets theory, EMT, which rejected the possibility of consistently successful active investing. The stock market boom, produced by the first internet bubble, appeared to invalidate all the analytical principles on which value investing was based. Value practitioners, with the notable exception of Warren Buffett, were dismissed as old-fashioned and out of touch with contemporary economic reality. Fortunately, the collapse of tech and telecom stocks between 2000 and 2002, coupled with the superior performance by value investors, revived interest in the Graham and Dodd approach. At the same time, a mass of published academic evidence powerfully contradicted EMT. Statistically constructed value portfolios generally outperformed the stock market as a whole over almost all extended periods, in almost all the national markets for which sufficient historical data were available. Increasingly accepted academic studies in psychology, pioneered by Daniel Kahneman and Amos Tversky, spawned the field of behavioral finance and provided an explanation for the historical outperformance of these value portfolios, grounding it in deeply embedded human behavioral biases. As a result, a value premium in returns appeared likely to be a persistent feature of future financial markets. These studies and continuing innovation by value practitioners led to a more thorough understanding of Graham and Dodd principles and marked improvements in value investing practices, especially with respect to identifying and evaluating what are designated as franchise businesses. The long bull market since the depths of the 2008-2009 financial crisis has once again raised questions about the validity of a Graham and Dodd approach. During the years since 2009, many notable value investors have significantly underperformed national and global market indices. Carefully constructed statistical value portfolios have seen the gap between value and overall market performance narrow significantly, if not entirely disappear. A new generation of technology stocks have provided sustained returns that again appear to contradict established value principles, and value investors are once again being dismissed as old-fashioned and out of touch with current economic reality. In part, a decline in the relative performance of value portfolios is a predictable result of the valuation excesses of the later phases of any long bull market. Value investors have historically performed relatively poorly in these periods, as they did in the late 1990s. However, other important factors appear to be at work. First, the renewed success of Graham and Dodd investing in the years from 2000 through 2007 increased the popularity of a value approach. Especially in the United States, the proportion of value-oriented investors rose significantly. An increased demand for value stocks may have compressed the spread between glamour and value stock valuation multiples, although the evidence is mixed. Second, economic developments have complicated the task of applying Graham and Dodd principles. The shift in economic activity from industry/manufacturing to services has increased the importance of intangible capital, customers, trained employees, product portfolios, and brand images relative to tangible capital inventories, accounts receivable, property, plant, and equipment that accountants have traditionally included on a business's balance sheet. Moreover, since investments in intangibles, advertising, hiring, training, and product development, are often counted as current expenses for accounting purposes, defining and measuring current earnings power has become more difficult. Technological developments have had a similar impact. Modern computer and internet-based firms like Amazon, Google, Oracle, Facebook, Microsoft, and Netflix have relatively little physical capital. Much of their growth-related investments are, for accounting purposes, buried in expenses, where they depress, perhaps excessively, reported earnings and raise some valuation multiples. A further complicating factor is the increasing extent to which service and modern technology companies operate in local geographic markets or niche product markets. These local/niche markets are characterized by potential economies of scale and, through continuous customer interactions, high degrees of customer captivity. The result is an increased incidence of dominant local/niche market competitors who benefit from significant barriers to entry. In the language of value investing, franchise businesses with wide moats constitute an increasingly large fraction of overall economic activity. For franchise businesses, net assets play a diminished role in determining profits, and growth contributes significantly to overall value. The consequence is that equity valuations depend heavily on future cash flows, and often far distant future cash flows, whose values are difficult to measure using Graham and Dodd asset value/earnings power value methods. Also, for franchise businesses, management performance, especially with respect to capital allocation, has an enhanced impact on firm valuations. Not surprisingly, in this environment, many traditional balance sheet-focused value investors have not done well. A final newly important factor that plays a role in the valuation of franchise businesses is the heightened potential for disruptive change that may undermine a firm's franchise position. For competitive businesses without significant economies of scale, any decline in profitability should be roughly offset by fixed and working capital recoveries as the business contracts. For franchise businesses, where earnings power value exceeds asset value, disruptive decline has much more serious consequences. Loss of economies of scale undermines earnings without any compensating return of capital. High returns on capital mean that lost earnings are only slightly offset by any realized capital recoveries. Dying franchise businesses are far less valuable relative to their pre-disruption positions than dying cigar butt businesses. Any attempt to invest in undervalued franchise businesses requires a careful assessment of the consequences of disruption. These changes mean that we have to revisit all aspects of the approach to value investing laid out in the first edition of this book. We have rethought the imperatives of searching for and then valuing potentially attractive opportunities once they have been identified. We have also carefully examined active research processes once a preliminary valuation has been made, and have looked at the issue of risk management far more extensively than we did in the first edition. In this revision, we have benefited from observing practicing value investors and noting the adaptations they have made to changing economic circumstances. In all these areas, we have explicitly measured the advantages of a modern Graham and Dodd approach against what is ultimately the fundamental challenge facing any active investor. While there is now overwhelming evidence that financial markets are not efficient in the academic sense, there is a fundamental and inescapable way in which markets are efficient. The average return to all investors in any asset class must be equal to the average return to all the assets in that asset class, i.e., the market return for that asset class. All the assets are owned by somebody, and derivative arrangements, e.g., uncovered short sales, net out since for every seller there is an offsetting buyer. Therefore, If one investor outperforms the market for a particular asset class, another investor must underperform by a compensating amount, weighted by the assets under management. Since this constraint applies to all asset classes, it applies to investments as a whole. Graham and Dodd were fully aware of this efficiency constraint, although they described it in slightly different terms. They understood that every time someone bought a security, thinking it was likely to do well relative to alternative opportunities, someone else was selling that security because they thought it would underperform the relevant alternative opportunities. Depending on the outcome, one of these investors always had to be wrong. The essential characteristic of a well-conceived investment process is that at every step, search, valuation, research process, risk management, it should place an investor on the right side of the trade. The process must be superior to that of the investor on the other side of the trade. This criterion is what we have used to explicitly measure the modern value investing practices described in this second edition. The search process involves not only a value orientation, a preference for non-glamorous, ugly, out-of-favor, and obscure stocks, but also some degree of specialization. If I, as a generalist, trade with an equally capable and highly disciplined specialist, the specialist will usually have superior understanding and information. He or she will therefore more often than not be on the right side of the trade. In this edition, we have extended the search chapter to include a discussion of effective specialization strategies. Recent experience supports this point. Highly focused value investors tend to be unusually successful, even compared to the value community as a whole. Successful but more broadly oriented value investors tend to perform better in industries and geographies where they have concentrated than in other areas. We have, therefore, added a number of specialized investors to our profile section. The Graham and Dodd concept of circle of competence applies not just to staying away from unfamiliar areas, but actively defining focused fields of expertise. We have, over the years since the first edition, learned a similar lesson with respect to valuation. Different assets with different return horizons present different valuation challenges. For liquidating assets or other short-term investments with catalysts, discounted cash flow, DCF, valuations are appropriate. The relevant cash flows are likely to be accurately estimated. Assets whose values are determined in competitive markets, real estate, natural resources, non-franchise businesses, are generally ones for which growth does not create significant value. This limits the importance of far future cash flows. For those investments, the Graham and Dodd asset value/earnings power value formula, which ignores growth, is better than a DCF or ratio valuation for reasons we discussed in the first edition of this book. It is the approach of choice for most value investors. However, it is not suitable for evaluating businesses for which growth creates significant value. In these cases, growth means that far distant cash flows are both difficult to estimate because small differences in growth rates compound into large differences in far future cash flows and constitute an important fraction of value. As a result, current intrinsic values for such businesses cannot be estimated with usual degrees of precision. Investment decisions are more usefully based on estimated future returns than estimated values. The major innovation in this edition of our book is the description through 3 extended chapters of a return-based approach to evaluating franchises businesses. The process we lay out may not turn out to be the last word in franchise business evaluation. However, we can say with confidence that a one-size-fits-all valuation approach is not likely to place investors consistently on the right side of the trade. Close observations over the years since 1999 of the practices of successful value investors has led us to add a chapter on active research practices to the second edition. The rise of the importance of intangible investments and franchise earnings as global economies have evolved has meant the traditional financial statement analysis is no longer adequate to evaluate many businesses. The increasing importance of the quality of management stewardship of these assets to returns has also forced investors to look well beyond published financials in evaluating investments. These imperatives have created unprecedented demands on the investment analyst's time. Properly and efficiently focused active research processes are increasingly important to investment success. A better research process will put an investor more frequently on the right side of the trade. In this added chapter, we describe what good active research processes look like. Finally, the increasing importance of specialization and active research has created significant problems in risk management. Historically, individual investment managers have tended to build portfolios as if they managed most, if not all, of their clients' assets. They selected levels of diversification without reference to the fact that the wealth owners typically spread their holdings among many investment managers. For wealth owners, it is the risks of their overall portfolios that matter. And these overall portfolios often include large, illiquid positions or businesses. In principle, wealth holders concerned with the risks of the complete portfolio should manage risks centrally. Decentralized risk management potentially leads individual investment managers to take offsetting positions. Manager A embraces risks that Manager B hedges, or positions whose returns are highly correlated with large, illiquid wealth holdings. The result may be an expensive risk management process that does little to reduce overall portfolio exposures. With specialized investment managers, the benefits of diversification must be achieved at the wealth holder level. Increasingly, therefore, risk management will be divorced from individual security selection. Centralized risk managers must receive sufficient information from their individual investment managers in order to do their jobs effectively. In light of these developments, we have included an extended discussion of risk management in the second edition. We carefully define risk from a Graham and Dodd perspective and describe effective practices for managing that risk. The continuing vitality of the Graham and Dodd tradition has always depended on successful adaptation to changing economic and financial conditions by practicing value investors. We have revised the profile section of this book with this in mind. If investors we covered in the first edition have since passed away, we have included the original profiles without change to preserve the valuable insights they had to offer. The others we profiled have continued to innovate and improve their processes. Fortunately, most of them have spoken annually for many years in the MBA Value Investing course at Columbia. For them, and other class speakers, we provide brief descriptions of where they stand in the broad spectrum of value investing practice and how their approaches have evolved over time. Taking advantage of the advances in technology, these summaries are supplemented with access to edited online videos of investors' classroom appearances. Most of the new investors we have added to the second edition, Tom Russo, Paul Hilal, and Andrew Weiss, all specialists to some degree, have spoken in the class many times and will be treated in the same way. Two other important investors, one seasoned, Warren Buffett, and one new, Jan Hummel, have not spoken in the class. For Hummel, we have presentations that we have edited for online access and which we have supplemented with a brief description of his specialized investment approach. As before, Warren Buffett will receive his own written chapter based on extracts from his extensive public commentary. When we began working on the first edition of this book in 1999, Bruce had taught the Value Investing MBA course about 5 times, with some additional run-throughs in Executive MBA and 2-day Executive Ed versions. 20 years later, even with a sabbatical now and then, he has taught it more or less continuously for around 25 years. In 2005, we published Competition Demystified, a detailed study of the factors that constitute sustainable competitive advantages, and what distinguishes franchise businesses, firms protected by barrier to entry, from companies subject to competitive pressures. And during those years, both of us have had direct investment experience, working in a large global mutual fund and 3 smaller hedge funds. There is no doubt that all the additional teaching, thanks to the students and the guest investors who generously contributed their time and expertise to developing the Graham and Dodd tradition, has expanded our own understanding. At least as important has been our time in the field, so to speak. As the historian Edward Gibbon wrote in his memoirs about his service in the 7 Years' War, the discipline and evolutions of a modern battalion gave me a clearer notion of the phalanx and the legion, and the captain of the Hampshire Grenadiers, the listener may smile, has not been useless to the historian of the Roman Empire. Bruce Greenwald and Judd Kahn, New York, 2020. 1. Value investing. Definitions, distinctions, results, risks, principles. What value investing is. Value investing is an approach to investing originally identified in the 1920s and 1930s by Benjamin Graham and David Dodd. Since then, the approach has developed and flourished in the hands of a notable but relatively small group of investors, the most famous of whom is Warren Buffett, who was their student in the early 1950s. As initially defined by Graham and Dodd, value investing rests on 3 key characteristics of financial markets. 1. The prices of financial securities are subject to significant and capricious movements. Mr. Market, Graham's famous personification of the impersonal forces that determine the price of securities at any moment, shows up every day to buy or sell any financial asset. He is a strange fellow, subject to all sorts of unpredictable mood swings that affect the price at which he is willing to do business. 2. Despite these gyrations in the market prices of financial assets, many of these assets do have underlying or fundamental economic values that are relatively stable and that can be measured with reasonable accuracy by a diligent and disciplined investor. In other words, the intrinsic value of the security is one thing, the current price at which it is trading is something else. Though value and price may on any given day be identical, they often diverge. 3. A strategy of buying securities only when their market prices are significantly below the calculated intrinsic value will produce superior returns in the long run. Graham referred to this gap between value and price as the margin of safety. Ideally, the gap should amount to about 1/2 and not be less than 1/3 of the fundamental value. He wanted to buy $1 for 50 cents. The eventual gain would be large and, more important, secure. Starting with these 3 assumptions, the central process of value investing is disarmingly simple. A value investor estimates the fundamental value of a financial security and compares that value to the current price at which Mr. Market is offering it. If price is lower than value by a sufficient margin of safety, the value investor buys the security. We can think of this formula as the master recipe of Graham and Dodd value investing. Where their legitimate descendants differ from one another, where each may add his or her unique flavor, is in the precise way they handle some of the steps involved in the process. Selecting securities for valuation, estimating their fundamental values, calculating the appropriate margin of safety required for each security, deciding how much of each security to buy, which encompasses the construction of a portfolio and includes a choice about the amount of diversification the investor desires, deciding when to sell securities. These are not trivial decisions. To search for securities selling below their intrinsic value is one thing, to find them, quite another. It is because the Graham and Dodd descendants have devised a variety of approaches to these tasks that value investing has remained a vital discipline through all market conditions in the more than 8 decades since Graham and Dodd first published securities analysis. What value investing isn't. A common and brief summary of value investing is that value investors search for and buy only bargains, securities selling for less than their true or intrinsic values. There is a problem with this simple definition. No rational investor admits to searching for securities selling for more than their underlying value. Everyone is looking to buy low and sell high. We need to be clear about what differentiates real value investors from all the others who trade in the securities markets. One large class of investors who obviously do not qualify are technical analysts or technicians. Technicians avoid fundamental analysis of any kind. They pay no attention to a company's line of business, its balance sheet or income statement, the nature of its product markets, or anything else that might concern a fundamental investor of any stripe. They care nothing for economic value. Instead, they focus on trading data, that is, the price movements and volume figures for any security. They believe that the history of these movements, reflecting the supply and demand for that security over time, traces patterns that they can analyze to infer future price movement. They construct charts to represent this information, and they scrutinize them for signs that will predict how prices will move next, and thus allow them to make a profitable trade. For example, momentum investors extrapolate the current price trend, buying securities whose prices are rising in the expectation that they will continue to go up. Sometimes they compare the day's price for the security to a trend line made up of a moving average of the last 30, 90, 200, or some other number of days' prices. Crossing that trend line, up or down, can indicate a change in direction. Surely they intend to buy low and sell high, but low and high here refer to the previous and future prices of the security, unconnected to its fundamental value. For technical investors, Mr. Market is the only game in town. It is also a game that lends itself to trading, buying and selling over a short term. Very few traders ignore technical information. Today's chartists are much more likely to use sophisticated computerized algorithms to detect patterns and to search for those patterns among different security prices rather than focus on the price history of a single security. But like most technicians, they are at best marginally interested in the fundamental economic value of the businesses underlying the securities. Even when we turn back to people who legitimately see themselves as fundamental investors, concerned with the real economics of the companies whose securities they buy, Graham and Dodd value investors are distinct. We can divide the class of fundamental investors into those who focus on macroeconomic issues and those who concentrate on the microeconomics of specific securities. Macro fundamentalists are concerned with broad economic factors that affect the universe of securities as a whole, or at least in large groups: inflation rates, interest rates, exchange rates, unemployment rates, and the rate of economic growth at the national or even international level. They closely monitor the actions of policymakers, like the Federal Reserve Board, and aggregate investor and consumer sentiment. They use their information to forecast broad economic trends. And they then use the forecasts to decide which groups of securities, or even individual issues, are likely to be most affected by the changes they predict. Their approach is often referred to as top-down, starting with the overall economy and working down to specific industries and securities. Like every other investor, they intend to buy low and sell high, using what they hope as their superior predictions to trade before the market as a whole recognizes what is happening. They do not, as a rule, do direct calculations of the value of individual securities or particular classes of securities, though such calculations could be consistent with a macro fundamentalist's approach. Although there are some famous and successful macro value investors in the Graham and Dodd tradition are basically micro fundamentalists. Within the society of micro-fundamentalists, those who analyze the economic fundamentals of companies and look at securities one by one, value investors in the Graham and Dodd tradition are still a minority. A more common approach to micro-fundamentalist investing takes the current price of a stock or other security as the point of departure. These investors study the history of this security, noting how the price has moved in response to changes in those economic factors that are thought to influence it: earnings, industry conditions, new product introductions, improvements in production technology, management shakeups, growth in demand, shifts in financial leverage, new plant and equipment investments, acquisitions of other companies, and divestitures of lines of business, and so on. There's more than enough to examine. They then try to anticipate how the critical variables on this list are likely to change, relying in large measure on company and industry sources, as well as their more general knowledge. Most forecasts focus on company earnings. Security prices incorporate the market's aggregate prediction about future earnings. If these investors find that their estimates of future earnings and other important variables exceed the market's expectations, then they purchase the securities. They assume that when new information about earnings and other matters are released, their predictions will be validated, and the market will drive up the price of the securities. They have bought low based on a superior estimate of the future, and they intend to sell high. Though this approach shares with value investing a concentration on economic fundamentals and specific securities, there are major differences. First, it focuses on prior and anticipated changes in prices, not on the level of prices relative to underlying values. One could apply this analysis equally well to a stock trading at 10, 20, or 50 times forecast earnings. A value investor would not regard these situations as equivalent. Second, this approach does not incorporate an identifiable margin of safety to safeguard the investment from Mr. Market's capricious behavior, which, after all, has been known to sink the price of shares in response to good news. So while Graham and Dodd value investing is most frequently a micro-fundamentalist approach, not all or even most micro-fundamentalists are value investors. Each of these alternatives to value investing can lead to a successful investment record, provided it is carefully and diligently pursued. Statistical studies increasingly suggest that security prices and volumes do trace consistent and recognizable patterns. There are positive serial correlations in the short run and reversion to the mean over the longer term. There are successful technical investors. Macroeconomic variables can be forecast with some accuracy and will affect securities markets in systematic and identifiable ways. There are successful macro-fundamentalist investors, analysts who energetically pursue information from company and industry sources, ferreting out trends ahead of the pack, should in theory, and sometimes do in practice, obtain above-average investment returns. Another approach to investing outside the value tradition rejects all these possibilities. It arose from modern portfolio theory and its sibling, the efficient market hypothesis, which were developed in academic finance departments beginning in the 1960s. The underlying premise of the theory is that current prices for securities, which are set by the collective perceptions of all market participants, accurately incorporate all the legally accessible information about future prices and values. Misperceptions and non-rational decisions are assumed to be essentially random. Excessive optimism, for example, on the part of some investors, would be offset by excessive pessimism on the part of others. Correct perception, by contrast, being shared by many energetic and intelligent investors, would determine market prices. These prices would reflect the best forecasts of future developments affecting the company's value. As a result, future price movements would depend either on random investor behavior or relevant new information that could not have been anticipated. Given these assumptions, future price changes would be unpredictable, and current prices would be the best predictor of average future prices. All attempts by individual investors to outperform a portfolio based on current prices would be futile, since all changes would be random. Now, given this view of security markets, the wise investor should focus on minimizing transaction costs and managing risk. The first task of risk management is to fully diversify away the idiosyncratic risks of individual investments, much as a risk-averse oil wildcatter drills a lot of holes to minimize the prospects of coming up dry by drilling only the few that look the most promising. For securities, this approach means buying a proportionate share of all the available risky securities to obtain the market return. Second, the remaining risk, the systematic risk, which cannot be diversified away because it is the risk of the entire market, can be managed by combining market portfolios with investments in a risk-free asset, normally short-term government debt. By adjusting the proportion of overall wealth allocated to the risk-free asset, investors can obtain the exposure from all-in risk-free to all-in-the-market portfolios that suits their appetite for risk. Should some individual investments offer a better risk-return trade-off than the market portfolios, well-informed investors would crowd into those opportunities. By driving up their prices and thereby lowering future returns, this activity would bring all prices back into the risk-return alignment that the efficient market theory posits as the normal condition. In the end, for investors who believe in market efficiency, the investment process consists of decisions about asset allocation, the right combination of risk-free and market, and minimizing transaction costs with index mutual funds and exchange-traded funds, ETFs. Extensive empirical evidence has largely discredited the strong form of the efficient market hypothesis, as some individual managers and firms have outperformed market portfolios over long periods of time. In addition, portfolios selected by simple statistical rules, such as those with lowest book-to-market value, have significantly outperformed market portfolios with no apparent increase in risk over extended subperiods, 15 years or so, going back to the 1920s in the United States. The same results hold true, with a few exceptions, for overseas markets throughout the periods for which adequate stock market return data has been available. Nevertheless, there is one important sense in which markets are inescapably efficient. The average return earned by all investors, weighted by assets owned in any asset category, must equal the average return on the assets that make up that category. For example, the total of the returns that investors in the U.S. stocks earn in any given period must be equal to the total return produced by U.S. stocks in that period. All these stocks are owned by somebody, and any related derivatives net out, e.g., for each short seller who does not own the shares in the question, there is a corresponding buyer of those non-existent shares. Since the total value of stocks at any moment must also equal the total value of investors' stock holdings, the average percentage return earned by investors in U.S. stocks must equal the average percentage returns produced by the U.S. stock market as a whole, the market return. This means that if some investors outperform the market in question, other investors must underperform by an equal amount. Before transaction costs, security trading is a zero-sum game. With transaction costs included, it becomes negative sum. A way to think about this constraint, one that should focus attention on its implications, is to recognize that every time you buy a security because you expect an above-average return, someone is selling it to you because they think the return will be below average. at least one of you will always be wrong. If the security does nothing, you will both lose the transaction costs, and one of you the foregone return on the risk-free asset. It should not come as a surprise, therefore, that when we take the effort and expenses into account, 80 to 90% of active fund managers have done worse than the efficient market strategy of buying low-fee index instruments. This inescapable reality is the most important feature of active investing, one that an active investor should never forget. An active investor must be able to identify convincing reasons why he or she will be on the right side of the trade more often than not. Why, in other words, you will earn above average returns. If you can't make that case, then investments in appropriate index funds make sense. We can acknowledge the effectiveness of index funds, known as passive instruments, because they seek only to mimic the market, not beat it, and make no investment decisions other than to be invested or not, without subscribing either to the idea that the price Mr. Market offers for a security is always the best measure of its fundamental value, or that no investment approaches will outperform a passive approach over time. Does value investing work? The case for value investing must confront this zero-sum constraint. The argument has both theoretical and empirical dimensions. We developed the theory in our detailed discussion of the procedures of modern value investing. Empirically, the historical record confirms that value investing strategies have worked. Over extended periods, they have produced better returns than both the leading alternatives and the market as a whole. Three distinct sources provide evidence of this superiority in practice. The first comes from a battery of mechanical selection tests. A researcher typically sorts all the stocks in the universe they have defined on a measure of value, such as a market price to the book value of the equity or market price to earnings. They group the sorted stocks into buckets, frequently deciles, from the cheapest value to the most expensive, glamour. They record the total returns for each bucket over a defined period, usually 1 year. Then they repeat the process for a number of years. At the end, they have the returns over a long period of time. Some go back 90 years, and can see how a mechanical value strategy has done relative both to the glamour stocks and to the market as a whole. Many studies have been conducted employing different versions of this approach. The results demonstrate almost invariably that the value portfolios produce better than average returns. Average here, meaning returns on the entire market, in almost all periods and all kinds of markets. Using Kenneth French's market-to-book data, the return of a portfolio that was long the cheapest 30% of stocks and short the most expensive 30%, a zero-cost portfolio before transaction fees, had a compound annual return of 3.35% from 1927 through 2018 on the gross amount invested in each bucket for an overall portfolio requiring no net investment. The outperformance has diminished since the publication of the article. Low price-to-earnings portfolios have had a similar success. Portfolios constructed of highly priced stocks, measured by market-to-book and price-to-earnings ratios, have done poorly. They are highly priced mainly because the companies have experienced rapid sales and earnings growth in the recent past, hence the label glamour. Unfortunately, all of that success and expectations that it will continue have already been incorporated into the stock price by the time the portfolios are constructed. These mechanical selections of stocks produce portfolios that look very much like those that a diligent value investor, analyzing stocks one by one, would construct, especially as value investing was practiced in its early period. But value investing is not the same thing as a mechanical approach, a computer program that selects stocks on the basis of a statistical measure that indicates which ones are cheap. Calculations of intrinsic value are usually more intricate and require more detailed knowledge of company and industry economics than are disclosed by simple financial ratios. Nevertheless, the striking historical success of these value portfolios produced by mechanical selection should remind us of the high standards that an active value investing strategy must meet. According to Standard & Poor's, more than 80% of active fund managers underperformed their market benchmark over a 5, 10, or 15-year period ending in June 2018. In that 15-year period, the S&P 500 returned 9.3% a year. The cheapest quintile of stocks sorted by earnings to price returned 11.8%. It is reassuring, therefore, that investment management institutions that have adopted systematic value strategies in the Graham and Dodd fashion have returned records that outperform the market as a whole. The performance of these institutions is our second source of support for the argument that value investing produces superior returns. Unlike the mechanical studies, which are back tests of selection rules applied to historical data, these institutions have generated real returns for real clients. Value investing works in the world as well as the lab. Finally, among those notable investors who have earned returns well above market indices over long periods of time, value investors who trace their intellectual origins back to Graham and Dodd are heavily overrepresented. The most famous of these is Warren Buffett. The list also includes many of the investors profiled in this book, those identified by Buffett himself in his 1984 article, The Super Investors of Graham and Doddsville, and others who have pursued value strategies without necessarily publicly embracing the Graham and Dodd tradition. The theoretical case for value investing starts with the zero-sum nature of investing. A consistently superior approach must succeed at the expense of investors who underperform the overall market. This success should rest on advantages at every stage of an active investment process, whether value-oriented or not. The process consists of 4 basic steps. The first step is to craft a search strategy. No investor can look carefully at all of the thousands of investments available in the world today. They must identify an intelligently selected subset of the entire group to examine. Ideally, this subset will contain a disproportionate number of opportunities that will more often than not put our investor on the right side of the trade. Some search strategies are determined by the nature of the investment firm. For example, a firm or fund that invests only in U.S.-listed convertible bonds has the origins of a search strategy built into its investment mandate. An investor who seeks out U.S. equities with attractive growth prospects, either with statistical screens or less formally by reading the appropriate literature, going to conferences, or talking with like-minded colleagues, has a search strategy. At a minimum, a good search strategy should answer the questions of why you are looking at a particular investment and why, given the opportunities identified by the search, you are likely to be on the right side of the trade it identifies. After the search strategy identifies a security for detailed investigation, the second step of the process is to decide what it is actually worth. This step is valuation. Whether valuation is done explicitly or implicitly, for example by picking stocks whose values are expected to increase, any investment decision must be based on the judgment that the future value of the security exceeds the price at which it can be purchased today. The various methods of valuation, like the alternative ways of conducting search strategies, define the investor's underlying approach. Technical investors assess future values based on prior price movements and trading patterns. Short-term fundamentalists adjust today's price for their estimate of near-term future developments at either the macroeconomic or individual security level. Efficient market investors default to today's price as the best measure of value. The point here is that everyone has a valuation rule. They are not all equally successful. The test of quality is the returns the investor earns by taking one side of the trade against someone whose valuation measure produces different, less accurate estimates. Most useful valuation methods will identify important uncertainties related to the value of the security under examination. Professional investors will employ a systematic process of active research to resolve these uncertainties. The first characteristic of a well-conceived research process is that it is focused on those uncertain variables that most importantly affect valuation. Meeting this criterion requires a sound valuation approach that identifies these key uncertainties. The research efforts that are mechanically focused on a predetermined list of variables, unrelated to their relevance to the particular investment in question, will not be as efficient as those driven by a superior valuation methodology. Second, there is always significant indirect information available that may either confirm or challenge the initial valuation estimate. For example, has the chief financial officer recently sold all of his or her shares? Are other well-informed and disciplined investors buying or dumping the shares? What are the commonly held beliefs that underlie the current price of the shares, and why do you think your valuation is better than the consensus? Know yourself. How have you acted in similar situations in the past? Have you made decisions that look like this one? And how have they worked out? Are you, in other words, a sucker for certain kinds of stories? An effective research process will collect and analyze this relevant indirect evidence to an extent that is at least as comprehensive and efficient within the law as that of the people on the other side of the trade. Finally, having searched, evaluated, examined additional evidence to check the initial valuation, and made a decision, every investor needs a process for managing the risk that this investment adds to or reduces in the portfolio. What is the appropriate size of the position within the portfolio? Does it move in tandem with other holdings, or does it have a low or even negative correlation with them? Will it provide insurance in a crisis as gold, cash, and derivatives may do? Unlike the trading of securities, risk management is not a zero-sum game, especially when different investors face different risks. But even at this stage of the work, it is useful to think in competitive terms. Are your definitions of risks and the processes you use to manage it at least as good as widely employed and available alternatives? Our contention is that the approaches developed by Graham Dodd and their talented successors are at each stage of the process generally superior to the methods commonly employed by those outside the value tradition. We aim to convince the listener that not only does historical evidence, statistical studies, firm performance, and the success of individuals support a value approach to investing, but that until others develop alternative processes at least as effective as those of the Graham and Dodd community, value investing will continue to prevail in the future. The rest of the book. Part 2 discusses valuation in depth, with chapters on valuing assets, earnings power, and growth. 2 detailed analyses are incorporated: Hudson General as an example of an asset value approach, and Magna International for an earnings power valuation. Part 3 focuses on franchise businesses and a new approach to valuing growth in these firms. Again, there are 2 detailed examples, this time for franchise stocks, WD-40 and Intel. Part 4 discusses research strategies and risk management. In addition to the text between the covers of this book, we have been able to make available online some of the presentations delivered over the years in the value investing course at Columbia Business School, taught for a quarter century by Bruce Greenwald and now by Tano Santos. Some of the most extraordinary value investors have devoted time and effort to make these presentations, in some cases virtually annually. We are grateful beyond measure to them and the contributions they have made to the evolving discipline of value investing. Appendix. Is extra return the reward for extra risk? One final issue regarding the factual evidence in favor of a value approach must be addressed. It is certainly possible that the higher returns achieved by value investing from each of these three sources, mechanically selected portfolios, value-oriented institutions, and individual Graham and Dodd investors, arise only because these portfolios are riskier than the market as a whole. If that were so, then their superior returns would be nothing more than an appropriate reward for bearing this increased risk. Many academic financial experts have been emphatic in arguing not only that higher return is the reward for higher risk, but also that there is no way to beat the market's average return other than by assuming additional risk, and that the best way to add risk is to leverage the market portfolio, since no stock selection process will outperform the market. The problem with this argument is that when standard academic measures of risk, either annual return variability or betas as defined by market finance theory, have been calculated for value portfolios, they have generally been no higher than the same risk measures applied to the market as a whole. In addition, value portfolios have proven to be less risky than the market as a whole when tested by other measures of risk, such as how much a stock drops in reaction to bad news about the company, the extent of price declines during bear markets, or simply the level of maximum loss experienced. These measures are closer to our common sense understanding of risk and more appropriate for value investors who regard price fluctuations as opportunities to buy or sell, not as accurate estimates of the intrinsic worth of the security. For our mechanically selected value portfolios, which have been subjected to the most thorough statistical scrutiny, their average one-year returns have been higher, their average 3-year holding period returns have been higher, their average 5-year holding period returns have been higher, they have provided superior returns during recessions, and they have outperformed glamour portfolios during the worst months for the stock market as whole. The value approach, even in its mechanical application, is no fair weather friend. Looking at maximum losses, drawdowns, in the 30 years from 1989 to 2018, the S&P 500 had two major bear markets. August 30th, 2000 through September 30th, 2002, 45%. October 21st, 2007 through February 28th, 2009, 51%. As a comparison, using Kenneth French's cheapest quintile as measured by earnings to price ratio, the two largest were June 30th, 2001 through September 30th, 2002, 19%, March 31st, 2007 through February 28th, 2009, 51%. In one case, the value portfolio lost considerably less money. In the other, they were equivalent. The compound annual returns for the entire 30-year period were 9.2% for the S&P and 12.9% for the cheapest quintile. Using drawdowns as a measure, it is impossible to say that the value portfolio outperformed by assuming more risk. As another alternative approach to risk, we refer to Warren Buffett's classic account of how he came to buy a large chunk of the shares of the Washington Post Company. The date was late 1973. It was a miserable time for the economy, the stock market, the national temperament, and naturally, a great moment for value investors. The market capitalization of the Washington Post Company had dropped to $80 million. At that moment, the whole company could have been sold to any of 10 buyers for at least $400 million. Well, clearly, Mr. Market was in a dreadful mood. Now, Buffett asked, had the market value of the stock declined again from $80 million down to $40 million, would that have made a purchase of the shares more risky? According to modern investment theory, yes, because it would have increased the volatility of the prices. According to Buffett, not at all, because it would have increased an already ample margin of safety and lowered whatever risk, he thinks there was none to begin with, existed in the purchase. As a calculation of risk, the margin of safety has nothing in common with the volatility of a security's price. In order to use it, you have to acknowledge the existence of an intrinsic value and feel confident about your ability to estimate it. 2. Searching for value. Finding the right side of the trade. The investment world offers so many choices that any serious investor needs to carve out a limited part of that world before beginning his or her analysis. Either by design or by practice, investors must specialize. Specialization is the first, most important yet frequently overlooked factor in an effective search strategy. As an extreme case, consider a situation in which one investor has spent 20 years studying and investing only in South Texas Gulf Coast onshore oil leases. A second investor flies in from Europe and, based solely on the belief that in politically stable areas such as the United States, oil is a good investment, buys an oil lease from our local expert. Well, sometimes that investment will work out. Oil prices may rise more than expected, or the leased property may have output capacity higher than anticipated. But there should be little doubt that most of the time, the local expert will come out ahead on a trade with a counterparty whose focus is on the price of a global commodity. Specialization, particularly in markets that are not intensely followed by a large number of other investors, is an obvious way to improve the odds of being on the right side of the trade. We will take our own advice in the discussion here and specialize on only a portion of the larger investment universe. We will not address areas like government debt, exchange rates, broad market-level instruments like index mutual funds and ETFs, or commodities like oil, wheat, or copper, in which many investors are making decisions based on macroeconomic factors. In avoiding these markets, we mirror the practices of most Graham and Dodd investors. We will also ignore the very simple investment choices, such as bank savings accounts and certificates of deposit, where there is limited scope for a professional investor to add value. Finally, we will not discuss areas like collectibles or intricate derivatives, where specialization is essential, but the knowledge required is very narrow, specific, and outside the interests of most investors, whether value or otherwise. We will concentrate on corporate securities, primarily equities, where the central value questions are related to the fundamentals of the underlying business. Benjamin Graham and David Dodd started here, and most value investors have followed their lead. Specialization. A well-established principle of Graham and Dodd investing is to remain within one's circle of competence. No investor is capable of understanding every business in every industry. Warren Buffett has often stated that he has no understanding of technology firms. When he invested in Apple, it was an extremely successful consumer goods company. Since they are outside his circle of competence, investments he might make in those industries are unlikely to land him on the right side of the trade. A circle of competence delineates one's areas of specialization. Investors should always stay within the circle and regard the regions beyond as unprofitable territory. The key difference between establishing a specialization and identifying a circle of competence is that specialization works from the inside out, starting from a particular industry or geography or other narrow area of interest. Once that area has been mastered, an investor may move on to adjacent areas of interest, mastering them one at a time. A circle of competence is generally described from the outside in, beginning with a full set of investment opportunities and eliminating those beyond one's current understanding. Formally, the two may ultimately be equivalent, especially for experienced investors, but particularly for beginning investors, a process of specialization is likely to be a more efficient way to define and develop fields of investing advantage. Thus, in what follows, we will focus our search discussion on specialization rather than more traditional circles of competence. This description actually understates the power of intense specialization. High productivity through the division of labor that Adam Smith described in a pin factory has been a cornerstone of economic prosperity for more than 2 centuries. Individuals specialize in professions such as law, medicine, accounting, journalism, education, and almost invariably on a relatively narrow segment area within the profession, like patent law, labor law, family law, and white-collar criminal law. Surgeons don't treat infectious diseases, and heart surgeons do not replace hips. Managers usually spend the greater part of their careers in one industry. Professional athletes who excel in one sport, even Michael Jordan in basketball, are generally out of their league when they try another, like baseball. Firms that succeed in particular industries, and sometimes in specific geographies, have historically outperformed firms that try to do many things, conglomerates, or operate on a global basis. Walmart could not replicate its success when it expanded beyond North America. Even within a well-defined circle of competence, investors have generally performed better starting from a very narrow focus and working outward. Warren Buffett has been more successful investing in insurance, banking, old media, and consumer non-durables than in other industries. Within the investment profession, the most common form of specialization is by industry. Analysts on both the buy and sell side of the market are almost always industry specialists. They commonly cover industries like autos, banks, retailers, or software companies on an increasingly global basis. The challenge for both investors and analysts is that there may be long periods during which there are no attractive opportunities within any particular industry. Fortunately, a viable circle of competence can extend beyond a single industry. An experienced investor or analyst should be able to master several, but those who attempt to become experts in many industries are likely to be masters of none, which puts them at a disadvantage when they trade against investors more focused in each area. This view of specialization is considerably more restrictive than what is traditionally considered a circle of competence. Geographical specialization is another useful constraint. Focusing on firms within a particular region is an advantage, particularly for those who invest in small to medium-sized companies. First, for service businesses that operate locally, a regional focus allows the investor to monitor customers, suppliers, competitors, and local business communities at a level of detail that cannot be matched by investors who attempt to cover the industry everywhere around the globe. Second, a local presence eases continuous access to management. Visits can be more frequent within a restricted territory, and the investor can see more of the business's operations. Compared to those who rely on annual fly-ins for meetings at company headquarters, the locally focused investor is much better informed about the current state of affairs and better able to assess where the business is headed. Third, many regional economies have an industry specialization. Medical devices in Minnesota, pharmaceuticals in New Jersey, information technology in Silicon Valley, biotechnology in Greater Boston, so that regional and industry specializations may overlap. For smaller companies with less analyst coverage, these advantages may be particularly potent. When Warren Buffett was running the Buffett partnership in the 1950s and 1960s, many of his most successful investments were in companies based in and around Omaha, often in insurance or related areas, not otherwise known as a hub of innovation or profitable investment opportunities. Specialization at the level of security selection need not conflict with the value of diversification at the portfolio level. The portfolio manager of a diversified fund can combine the choices of a group of analysts to run a product that has the benefits of both detailed industry or geographic knowledge and risk control features that come with diversification. At a higher level, the overall holdings of an institution or household can be more diversified across asset classes and yet be composed of securities selected by specialists operating within narrowly circumscribed circles of competence. Although reaching this goal by choosing the right investment managers is not an easy task, it is possible. We will address the challenge directly when we discuss risk management in Chapter 10. Most investment managers have resisted specialization in the manner we have described here, even though specialization represents the element of a search strategy that is most likely to put the investor on the right side of the trade. The value advantage. In the first chapter, we mentioned a number of studies that employ a mechanical approach to stock selection to test various investment styles. These studies use one or several variables to rank the universe of stocks at a given moment. Group these ranked lists into equally sized buckets and compare the investment returns of these groups, now considered portfolios, over future periods. And overall, these studies demonstrate convincingly that portfolios of stocks ranked high on value outperformed the market as a whole, and trounced portfolios ranked high on glamour, meaning they were expensive by the measure chosen. A few noteworthy examples will illustrate the nature of this research. As we noted in Chapter 1, in 1992, Eugene Fama and Kenneth French published a seminal paper intended to reinforce the efficient market hypothesis. Using data on U.S. common equities from 1963 to 1990, they sorted stocks into 10 groups based on book-to-market values from the lowest, glamour stocks, to the highest, value stocks, at the end of each year. They also sorted the same stocks based on size as measured by market capitalization. They then measured the monthly performance of each basket of stocks for the period July 1963 through December 1990. The average monthly return for the highest book-to-market decile was 1.63%. For the lowest book-to-market, it was 0.64%. The value decile outperformed the glamour decile by around 12% a year over the entire period. A similar, if slightly smaller, return difference emerged between small and large stocks. The smallest basket averaged 1.77% per month compared to 0.95% for the largest. Combining the two sorts to create 100 buckets, ranking from largest and most expensive to smallest and cheapest, added little to the picture. The smallest and cheapest averaged monthly returns of 1.92%. The largest and most expensive, 0.89%. Two findings of their work stand out. First, it is difficult to improve on a simple value strategy by adding additional variables. The cheapest decile outperformed the most expensive by 0.99% per month. Adding size, the smallest and cheapest yielded a premium of 1.03% per month, an economically insignificant gain of 0.04%, and one difficult to capture in practice because of the liquidity constraints imposed by small company shares. Second, most of the premium for value lies at the extremes. Going from the third cheapest decile to the first added far more to the return than moving from the eighth to the sixth. And the same pattern held at the glamour end. Moving from the third most expensive decile to the top detracted far more than moving from the middle to the third. In searching for value and avoiding glamour, it is the cheapest of the cheap you want to embrace and the most expensive you want to avoid. A second notable paper published in 1994 by Joseph Lakonishok, André Schleifer, and Robert Vishny replicated the Fama and French study over a slightly different period. It used earnings to price and cash flow to price as alternative measures of value. The findings are similar. The most extreme value portfolios outperformed the most extreme glamour portfolios by around 9% annually, regardless of the value metric employed. Adding a second dimension to the analysis, the authors sorted their universe of stocks into 3 groups based on price to cash flow and 3 based on sales growth over the prior 5 years. They found that the value stocks with the slowest rate of sales growth returned 21% a year on average, whereas the glamour stocks with the highest sales growth returned 11%. A third key study published in 1989 by Werner de Bont and Richard Thaler examined the impact of past stock market performance on returns going forward. At the beginning of each year, they sorted the universe by total market return over the previous 12 months. They focused on 2 buckets, one containing the stocks in the lowest decile of returns, worst performers, and the other with the stocks in the highest decile, best. They then tracked the difference between the returns of the 2 portfolios over the subsequent 30 months. Over that entire period, the 2 portfolio returns were approximately equal. Although in the first 12 months, the best prior performers continued to outperform, this is a well-established momentum effect, about which more later. They then repeated the process using the previous 24 months of returns to sort for the worst and the best performers. The most disappointing stocks over the prior 2-year period outperformed the high-return stocks by about 12% over the next 30 months. Finally, they formed portfolios from the stocks that had done the worst and the best over the prior 36 months. These long-term worst stocks earned returns on average of 18% above those of the best stocks over the subsequent 30 months. Again, the more extreme, in this case the most extended the period of underperformance, the greater the outperformance going forward. An extensive group of studies examining equity returns in the United States and overseas over longer time periods confirm these general results. Portfolios of ugly, disappointing, obscure, small, and boring, e.g. low-growth stocks, repeatedly generated higher returns than both the market as a whole and, more strikingly, portfolios of attractive, highly profitable, well-known, big, and glamorous, e.g. fast-growth stocks. Their low prices more than compensated for their unappealing characteristics. Moreover, as these studies demonstrate, especially that by de Bont and Thaler, it is the extremely unappealing portfolios, 3 years of disappointing returns, that produce the best results. The future returns of portfolios organized by market-to-book ratios increase steadily with the degree of cheapness. The cheapest decile bucket of stocks often see 2/3 of the companies go bankrupt. But the ones that do survive do so well relative to their very low starting prices that the ugliest portfolios are the best performing among all the buckets. In addition to these basic value/glamour measures, other variables have been studied to assess their impact on portfolio performance. They come in 3 varieties. 1, purely fundamental. 2, purely technical. 3, a combination that relates market price to a fundamental factor like price to book value or price to earnings. Those that use only fundamental variables refer only to a company's business performance, not the relationship between the performance and its share price. Studies have sorted stocks using returns on equity, or on total capital invested, growth in earnings per share, growth in assets as opposed to sales growth, and various measures of profit margins. Companies with high marks on these variables are successful firms whose shares are inherently attractive to investors. However, consistent with the studies we discussed before, it is often the firms that ranked lowest on these measures, low returns on capital or narrow profit margins, that have tended to generate the highest future market returns. At worst, these studies demonstrated little or no positive relationship between future returns and the quality of current firm performance. Michelle Clayman's telling phrase, "in search of disaster," has been a better investment guide than "in search of excellence." A supportive example of this phenomenon emerged from the widely read and much admired book, Good to Great, by Jim Collins. Collins selected 11 companies that transformed themselves from good to great. His selection was based on hefty stock market outperformance over the prior 15 years. He and his researchers identified the common characteristics that distinguished the greats from peers who did not make the transformation. The book was published in 2001. In the next few years, two of the great firms, Circuit City and Fannie Mae, managed to go bankrupt, in the case of Fannie Mae, in a spectacular fashion. For these two, good to great became good to great to gone. A second type of study examines stock market returns and trading volumes without reference to any fundamental data and looks for patterns like those in the DuBont and Thaler paper. This is technical investing, most commonly focused on price momentum. A frequently used metric is relative strength, which is simply the price performance of the stock relative to all other stocks in the pool. Choosing a portfolio of last year's best performing stocks is a bet that winners will continue to excel, and the bet is paid off. For the 40 years from 1979 to 2018, a portfolio that was long the prior year's best 30% performers and short its worst 30%, returned 4.2% annually. In the period since the recovery in 2009, when bull market returns belied traditional value measures, this momentum approach returned 2.8% per year. But momentum plays out fairly quickly. The French portfolios are rebalanced every month, and as DuBont and Thaler discovered, when stocks are selected on the basis of price change over 3 prior years rather than last year alone, the results are reversed. The worst do better. The high flyers fall back to earth. The downtrodden arise. We witness a phenomenon found so frequently in nature and culture, reversion to the mean. The children of tall parents do not on average exceed their parents in height. If they did, centers in the NBA would not command the salaries they do. And if prior winners in the stock market continued to outperform over sustained periods, their market capitalizations would rise to the sky, leaving behind any fundamental value that might support the share price. There are manias in the history of investment. They always collapse. The third type uses both financial and price variables to relate the price of the shares to some fundamental company information. Share price to earnings, share price to cash flow, share price to book value, share price to sales, share price to dividends, and more. The Fama French paper is in this camp, as is that by Laconishak and co-authors discussed before. In all of these studies, the value stocks, those with low share prices relative to each of these other variables, outperform the glamour stocks. These ratios offer slightly different snapshots of the same underlying picture. How many investors are willing to pay for the future success of the company, whether measured by earnings, cash flow, sales, net assets, or dividends? The less investors want to pay, the better the prospects of the shares, if not the company itself. Overall, the statistical evidence both for the United States and overseas markets paints a remarkably consistent picture. Embracing stocks that are ugly, boring, obscure, disappointing, and therefore cheap has historically been the best way to buy stocks, in which you are likely to be on the right side of the trade. These are the stocks that have outperformed the market as a whole. The uglier, more boring, more obscure, more disappointing, and therefore usually the cheaper the stock, the better the returns have been. That, at any rate, is the historical record. And that history, thanks in large part to studies we have cited and more we have not, is now widely recognized. The next and obvious question is whether this situation will persist. The argument in favor of persistence is the fact that the value premium, the return advantage of value relative to glamour stocks, which was first identified by Benjamin Graham in the 1930s and systematically quantified since the 1970s, appears not to have diminished significantly over time. Nevertheless, it is crucial to understand why value search strategies worked so well in the past and whether the forces responsible will continue to operate in the future. The anomaly of value and the nature of human behavior. Superior investment returns from value stocks over time constitute an anomaly. Once investors know that cheap stocks outperform expensive stocks, they should bid up the price of the cheap stocks and eliminate the superior performance. Yet the value premium has endured. There have been two distinct responses to the evidence that cheap stocks provide superior performance. One seeks to explain it, the other to explain it away. The explanation for why the value anomaly exists in the first place has been durable over time and is likely to persist into the future, lies in certain deeply embedded features of human behavior. These behaviors lead people to make decisions that violate rational economic calculations. They are apparent in activities like the ubiquitous popularity of lotteries that produce negative returns, a fact that virtually everyone knows, even as they buy their tickets. They have also been identified and investigated in the field of cognitive psychology, most notably by Daniel Kahneman and Amos Tversky. The field of behavioral finance is a direct outgrowth of this work. Three of these behaviors are particularly important for understanding the existence of the value premium. First, human beings have always been prone to overpay for the dream of getting rich quickly. Lotteries, as we mentioned, have been successful ventures in almost every society and in every period of human history for which we have a record. Yet lotteries are, and have always been, astonishingly poor investments. Lottery operators, whether governments or criminal associations, have taken between 30 and 70% of the cash paid in before distributing the rest to the winners. People who buy lottery tickets know that the odds are seriously stacked against them, but that knowledge has not made lottery tickets harder to sell. They have persisted, even when they have been made illegal. A broad cross-section of the population buys tickets. The appeal of instant riches is not confined to the poor or less educated. In the more sober world of equity investing, glamour stocks are the lottery tickets that hold out the promise of spectacularly high returns. Because of this appeal, some investors are willing to pay irrationally high prices relative to their fundamental values. This pattern came into sharp focus, at least after the fact, during the technology boom of the late 1990s. Established companies such as Intel, Microsoft, AOL, and Cisco, plus a large group of immature startups, commanded what were, in retrospect, absurd prices. But even during less frothy times, glamour valuations are a regular component of equity markets. Sometimes it is national markets, such as Japan in the late 1980s or the BRICS in the 2000s. Sometimes it is specific industries such as telecommunications or biotechnology. Sometimes specific companies such as Apple or Cisco that trade at prices inflated by their lottery ticket appeal. Investors who succumb to this widely shared attraction will, as a group, underperform the market as a whole. Given the zero-sum nature of investing, value investors who take the other side of these trades will outperform. As long as lotteries and their stock market equivalents retain their attraction, this source of the value anomaly is not likely to disappear. The second major behavioral feature contributing to the value anomaly is an inverse of the preference for lottery tickets. In investing as in life, humans avoid situations that look ugly, troublesome, and appear to offer a high probability of loss, and lack the perverse highs associated with more exotic forms of risk-taking, such as skydiving. In the field of behavioral finance, this trait of investors is referred to as loss aversion. For most people, the pain of an anticipated loss outweighs the pleasure of an equivalent gain. As a consequence, people will embrace highly risky choices to avoid certain losses that they would never countenance in exchange for foregoing certain gains. As a consequence, if offered a portfolio of stocks, 2/3 of which may go bankrupt, most investors will recoil in horror before considering the potentially enormous gains from the 1/3 that do survive, gains large enough to make the whole investment highly profitable. It should come as no surprise that these investors avoid ugly and disappointing stocks in the first instance, and for stocks that do turn sour when already owned, dump them reflexively on the market without careful analysis of the events that have given rise to the ugliness and disappointment. The natural consequence is that these stocks will be chronically undervalued. Being on the other side from this behavior should be comparably rewarding. Again, this kind of loss and/or ugliness aversion has been a part of human behavior for millennia and is unlikely to change anytime soon. The third psychological factor underlying the value anomaly is so deeply embedded in human behavior that it dominates discourse without widespread awareness of its impact. Humans have an innate tendency toward overconfidence. We embrace certainty and ignore alternative possibilities. In discussions of public policy issues, such as the presence of weapons of mass destruction in Iraq in 2002 to 2003, few talked of probabilities. The discussion was couched in the language of competing certainties. One side insisted that the weapons were there for sure. The other side insisted with equal certainty that they were not. Virtually no one ever addressed the issue in terms of probabilities, such as probability of 1/4 or 1/3 or 1/2 or 2/3. Framing the issue as a set of alternative probabilities was simply not part of the debate. After the fact, of course, they were either there or not there. But beforehand, no one knew for certain whether the weapons were there or not. Rational opinions should have taken the form of these kinds of probability statements. Both rhetorically and in their own minds, each side of the debate was radically overconfident in the likely accuracy of their judgments. Such overconfidence is a systematic human tendency. Overconfidence dominates investment thinking and discussion in the same way. When talking about good stocks with great prospects, advocates never say that they are likely to outperform average market returns 2/3 of the time. An investor who achieved that degree of accuracy over any significant period of time would be in the top 10th of 1% of all investors. They tout the stocks with absolute assurance and are very surprised when they subsequently underperform the market. Those who recommend avoiding other stocks do so with the same degree of certainty. They talk of poor investments as dogs, not as stocks with at least some possibility of substantial gains. The effect of this overconfidence is to intensify the overvaluation of the glamour stocks, since the possibility of an unanticipated adverse consequence is implicitly minimized. At the same time, overconfidence amplifies the undervaluation of ugly and disappointing stocks, since their potential recoveries are similarly minimized or ignored. Overall, overconfidence works to magnify the return distortions between glamour and value stocks. Until evolution works to eliminate it as a human characteristic, the value anomaly is likely to persist. Overconfidence also adds an important temporal dimension to the value anomaly. In good times, overconfidence tends to lead investors as a whole to minimize potential negative future developments, much more than a rational calculation of probabilities would suggest. Investors extrapolate present favorable conditions into the indefinite future. Evidence of this practice appears in those recurring radical overvaluations in market prices that Robert Shiller has labeled irrational exuberance. In these periods, estimates of market volatility, which are implicit in the prices of derivative instruments, typically fall to historic and unrealistically low levels. In good times, option prices tell us that investors typically expect smooth sailing, when the historical record shows that on average, subsequent market movements have been exactly the opposite. In bad times, when prices have fallen and the economic outlook is gloomy, investors are doubtful that good times will ever return. They are overconfident in their pessimism. Then demand for option protection is correspondingly high, and options are expensive. In a very real sense, the neurotic extremes of Benjamin Graham's Mr. Market are a tribute to the power of overconfidence. Unless Mr. Market somehow settles down, either through finding the right bipolar medication or from a change in human behavior, intertemporal and thus cross-sectional value anomalies will continue to exist. Psychological experiments indicate how difficult it is to escape this overconfidence. In one well-known experiment, subjects looking through eye holes into a darkened room were asked to estimate the distance to a luminous square. Since they were not told the size of this square, squares of different sizes were selected at random and placed at random distances. They could not possibly give an accurate estimate of this distance. Yet subjects invariably gave a precise distance estimate in feet, and when asked to judge the likely accuracy of this estimate, gave error brackets that were small, e.g., plus or minus 1 foot. Faced with a situation of fundamental uncertainty, the subject reflexively embraced a high degree of certainty. In fact, their estimates of distance were completely unrelated to the actual positions of the squares, and their actual average errors far exceeded their error estimates. The experimenters then showed their subjects the squares of different sizes and explained that squares would be chosen at random. The experiment was rerun, and subjects continued to give precise estimates of the square locations. Their error estimates did increase, e.g., from 1 to 2 feet, but remained well below the actual errors. Overconfidence appears to be highly persistent, even in the face of contrary evidence that seems to be discounted via a mechanism known in the behavioral literature as hindsight bias, the "I knew that already" impulse. A large number of other experiments have been run with both experts and lay subjects who are asked to estimate present or future quantities. Both groups persistently overestimate the accuracy of their judgments, and if anything, the experts are worse than the lay subjects. A further issue regarding the past and future of the value anomaly concerns the organizational structure within which investment decisions are made. Individual investors may well continue to be subject to lottery preference, loss aversion, and persistent overconfidence. However, as most investment dollars are now in the hands of investment organizations, these organizations should in theory be able to put rules and structures in place that control aberrant or counterproductive individual behavior. Still, it is individuals working for organizations that make and implement these processes. These people have their own interests and agendas, some of which may not be in line with the interests of the organizations for which they work. They also have their own psychologies over which they may have little control. Organizational policy will always be in tension with the instinctual behaviors and incentives of both their own employees and their retail and institutional clients. Therefore, it makes sense to think about both organizational imperatives themselves and the behavior of managers within the organizations. When we do that, it will become clear that organizations are as likely to amplify individual behavioral biases as to reduce them. For organizations, investment biases are generally a consequence either of policy or size. We'll start with policy. Many investment organizations are prevented, whether by charter, by stated investment policy, or by legislative intervention, from owning certain kinds of stock. Shares of companies that engage in businesses deemed socially irresponsible, whether for environmental, health, or regime-related reasons, are off limits. If many funds adopt policies that compel them to avoid the same companies, the normal demand for these shares may be substantially reduced. Unless there are enough funds with socially irresponsible investment mandates, buy only stocks of tobacco companies, manufacturers of defective infant car seats, or polluters, shares of the dirty companies may be permanently undervalued as measured by current earnings or growth prospects. It will take a change in investment policy, a change in corporate social behavior, or a reorganization of the business to eliminate this prohibition and allow the shares to be revalued upward. So long as the prohibition is stable, the stocks may remain permanently depressed. The issue of size bias is more important and more interesting. Many funds cannot invest in small companies either because their mandates do not allow it, or more frequently, because they have too much money to manage, and small companies just can't absorb enough of it to make it worthwhile. If a diversified investment company, most mutual funds, with $10 billion to invest, wants to own stock in 100 companies, it needs on average to buy $100 million in each. Since the fund does not want, and is often not allowed, to own more than 10% of any company's stock, this limits the universe of investment choices to firms with market capitalization of $1 billion or more. The specific sizes of funds, the market capitalization of suitable firms, and the percentage of ownership will vary, but the impact of company size persists. Many funds simply cannot buy shares in small companies. For similar reasons, investment analysts within institutions will also concentrate on large capitalization opportunities. An insight into a $40 billion company that can absorb a $2 billion investment will be worth far more than an equivalent insight into a $400 million firm that can absorb only $20 million. The consequence is that coverage of and demand for small company shares will tend, all other things being equal, to be below that of large company shares, and small company stocks should be cheaper. Hence, the shares in small companies are cheaper, all other things being equal, than shares in large companies. Among the all other things that need to be held constant, growth prospects are the most important. Small companies typically have the opportunity to grow faster than large ones, which already control major segments of the markets in industries that are likely to be well developed. The only thing that small companies need do to qualify for large funds is grow. There are plenty of other investors out there to raise the value of the company's shares as its revenues and earnings increase. At some point, a small company with a market capitalization of $200 million has grown into a mid-cap firm with a capitalization of $1 billion. As it matures, it becomes an eligible purchase for more funds. Its shares are priced at less of a discount. It ceases to be an opportunity and emerges as a success. This cycle is one of perpetual renewal, and new small firms spring up to take its place in the shade. The shares of companies too small for big funds are always available on sale. A revealing example of the size bias, as it affects stock performance, concerns the record of corporate spin-offs. Sometimes a company rids itself of a division or other unwanted business unit by issuing stock in this new corporation and distributing them to existing shareholders. The shares in this spun-off company now trade on their own. In most cases, the new firm is small, especially when compared with the giant from which it has just been separated. Funds that own stock in Giant now find themselves holding shares in new micro-enterprises with a market capitalization of $100 million. They may know little about the new business, but are certain of one thing: it isn't big enough for them to spend much time learning about it, since it is too small for them to buy. So they dump the shares on the market, and pocket the money. Spin-offs are a wonderful opportunity for investors who are not constrained by questions of market capitalization. Since many of the shares are sold for reasons unrelated to the company's prospects, there are bound to be gems tossed away by the large funds for whom a small company's stock, though perhaps a potential star, is still a nuisance. Spin-offs intensify the small company bias. The ordinary small company has its shares ignored by the large funds. The spin-off has them actively sold off. This is only an extreme illustration of the organizational bias against the shares of small companies that has made them, over time, a fertile field for value investors. Client demands are a second influence on organizational behavior. Investment company managers, whose clients are individuals, must respond to the irrational biases of those individuals. Organizations who invest for institutions such as charitable endowments, pension funds, and family offices must answer to the non-investment professionals who often run those institutions, human beings with the usual individual behavioral biases. In marketing to clients, investment managers spend more time discussing their big winners, investing in Apple at $10 and seeing it subsequently go to $700, and devote less attention to their long-term average returns and to the investments that did not work out. The need for great stories to tell induces the organizational managers to over-invest in the same glamour stocks as individuals. When an organization discloses its portfolio holdings, clients are likely to judge them, at least partially, on the basis of their own loss aversion. Portfolios of troubled, disappointing stocks are a hard sell to clients. As a result, organizations are prone to window dressing by purchasing shares of respectable, high-growth, high-return stocks just before any disclosures are due. This behavior reinforces rather than offsets the tendency for such stocks to be overvalued and amplifies the undervaluation of the diseased and disappointing stocks that they avoid or sell before they disclose holdings. Finally, there is substantial evidence that institutional clients tend to remain with their existing investment managers unless these managers significantly underperform their relevant market benchmarks. The risk minimizing path for organizations is to buy what everyone else is buying. This herding instinct reinforces the tendencies to buy stocks that are glamorous and have recently been successful and shun the value stocks that have disappointed. In the mid-1960s, these forces led organizational investors to focus largely on the Nifty 50 stocks. These were large, stable companies: IBM, AT&T, General Motors, Xerox, Morgan Guarantee, that both managers and clients saw as having high return potential with little risk. Between 1965 and the end of 1974, a Nifty 50 portfolio typically lost more than 80% of its value. But the lessons of investment history have a short half-life. The cast of managers and their clients changes rapidly. In 2015, all of the gains in the S&P 500 came from 4 stocks: Facebook, Amazon, Netflix, and Google. The Nifty 50 had become the FANG 4. Microsoft and Apple joined the select group in the next several years. Any management firm that did not join the chorus almost certainly suffered by comparison. Organizational imperatives, unless they change radically, appear unlikely to undermine the value anomaly in the future. The herding impulse is also felt by the individuals within investment companies who make the actual investment decisions. Money managers are employees hired to produce results by following prescribed investment policies. Though there may be rewards for original thinking that leads to extraordinary success, the safest path is to look pretty much like everyone else investing with the same mandate. The now antiquated adage of data processing managers that nobody was ever fired for buying computers from IBM applies as well to money managers. Nobody loses a job for average performance or for holding the same securities as the rest of the managers. If you stray and buy stock in a company that nobody else wants, the payoffs are skewed. Should the company recover and the stock rise, the praise is real but short-lived. If the company does poorly and the stock falls, everyone remembers that you chose that dog. The situation becomes most extreme toward the end of a reporting period, when managers, as we have noted, window dress their portfolios, dumping the stocks that have fallen in price and loading up on the past year's or quarter's successes. This pruning has the effect of driving up the price of currently successful stocks and depressing even further stocks that are already downtrodden. The pressures on individual managers within organizations largely mirror the pressures on the organizations themselves. They tend to reinforce rather than offset the value anomaly. Taken as a whole, these elements of human psychology and organizational behavior provide an explanation for the empirical data that has demonstrated the superiority of a value-oriented search strategy. Look for opportunities among ugly, disappointing, boring, obscure, small companies. As long as they continue to play their historical role going forward, the value strategy will continue to outperform, even after evidence about its exceptional performance has been widely disseminated. Thus, in a world where there are colossal rewards for uncovering discrepancies between the current price of a stock and its true, intrinsic, or ultimate worth, some discrepancies persist. These discrepancies outline the types of opportunities in which a searcher for fundamental value is more likely to be on the right side of the trade. Explaining away the value anomaly. The behavioral and organizational features that we have described are at the center of our efforts to explain the existence and persistence of the value anomaly. A second approach, to which we alluded earlier, is to try to explain it away. This approach assumes that the value portfolios are riskier than the market as a whole, which in turn is riskier than glamour portfolios. In a rational market, greater risk should be associated with greater reward. It is higher risks that explain the anomaly of above-market returns for value portfolios and lower risks that explain the below-market returns of glamour portfolios. Essentially, this explanation is defense of the efficient market hypothesis. But if the pattern of relative risk explains return variations, the risks at issue should be observable and measurable. Otherwise, how would investors know which stocks should command higher returns? By risk, here we are referring to volatility, accepting for the moment the meaning of the term as defined in the efficient market hypothesis. Unfortunately, for the efficient market theory, historical statistical evidence suggests that value portfolios have been no riskier than the market as a whole, and that glamour portfolios have, if anything, been riskier than the market. These results persist whether we use variance as the volatility measure or beta, comparing the responsiveness of the portfolio to changes in the market as a whole. To repeat, if volatility is our definition of risk, value portfolios have not been riskier, and glamour portfolios have been less risky than the overall market. A disciplined value investor, employing sound value approaches to risk management, should not hesitate to look for opportunities to produce higher than average returns in exchange for taking on theoretical, albeit undetectable and perhaps non-existent, higher risks. Search strategies in practice. In principle, specialization and value-based search strategies are complements and not alternatives. In practice, their relative weights depend on the particular mandate under which an investment manager operates. Managers with broad mandates, large cap global equity, United States fixed income, or responsibility for the greater part of the wealth of their investors, will necessarily have well-diversified, value-based search strategies. Even under these conditions, however, the benefits of specialization apply. Developing industry or geographic expertise will still enhance the chances of being on the right side of particular transactions. For investors with more restricted mandates, expected to hold portfolios with fewer and larger positions, specialization will be a necessary point of departure. But whether in industries or geographies, value principles still apply. Looking initially at small, boring, ugly, and disappointing firms within the parameters of a specialization will have all the advantages that we described before. Indeed, the advantage of specialized knowledge is likely to be even more significant with respect to value stocks when one is considering wounded companies. And the critical and difficult challenge is to distinguish those that are terminally ill from those that are only temporarily impaired. Specialized knowledge develops slowly over time. Older, more experienced investors will be capable of managing a greater range of specializations than newly minted ones. The experience of successful specialists suggests that at a minimum, it takes a concerted effort of 1,000 hours or more to develop a decent working knowledge of an industry. Given the other demands on an investor's or analyst's time, that translates into at least a full year to achieve an adequate level of mastery. The knowledge and experience that constitutes specialized expertise must be constantly nurtured and extended, especially in times of transition and uncertainty. For example, retailing has historically rewarded superior merchandising talent, such as the ability to create positive store experiences and select the right products. Successful retailers have generally been outstanding merchants. The rise of Walmart was built on the increasing importance of efficiency in local store operations, and especially logistics. Local market share, thanks to the density of stores, with the associated benefit of scale in local storage management, distribution, and advertising, all of which allowed for lower prices, became far more important than innovative merchandising, which is much easier for competitors to copy. The increasing importance of web retailing diminished the importance of store operations and elevated distribution logistics and order management into significant sources of retail success. Understanding the nature and pace of these transformations is essential for evaluating both the strengths of competitive positions and the competencies of individual retail managers, upon which successful retail investments depend. Only by continuously deepening one's retail specialization will an investor be able to keep abreast of such developments. A second benefit of continuous industry or geographic engagement is the cultivation of an improved network of industry contacts. Attempting to do everything oneself is not usually an efficient approach to investing or, indeed, any undertaking. Being industry-focused means following and repeatedly interacting with operating managers in a particular industry, which can produce a sharper understanding of their strengths and weaknesses and a better calibrated judgment of their opinions regarding industry developments. Maintaining productive relationships with other capable industry experts also has value, especially when these other experts have geographic focus different from one's own. Value-based search strategies come in two varieties, quantitative and qualitative. At one extreme, quantitative strategies seek to reproduce or improve on the laboratory portfolios whose outperformance constitutes an important part of the case for a value approach. These strategies use statistical measures of cheapness, size, price momentum, and industry/company level accounting information to build portfolios from the stocks within the value buckets that these variables have defined. Often these portfolios are modified to limit or overweight concentration in particular industries or geographies in order to control overall portfolio risk. Some quantitative managers adjust the underlying models generating these portfolios to respond to putative evolution in market conditions. These adjustments are not always successful. Some managers run portfolios for which these search strategies are not just the beginning, but also the end of the investment process. These quant value managers may have been successful, but the ubiquity of computing power and statistical expertise have allowed others to quickly detect the specific strategies, and by crowding in, curtail if not eliminate any quant advantages beyond a simple value approach. Other managers begin by using software and financial databases to generate lists of potentially desirable investments, from which they select certain companies for further detailed investigation. Basic measures of size, cheapness, and disappointment are used to screen for potential investment. This practice has limitations. On the one hand, given the large number of potential securities, even screens that employ three variables, e.g., small size, low market to book, low prior returns over the previous 2 years to limit the list, will produce a long, highly varied set of companies across many industries and geographies. Such a list may be dauntingly large. Also, it changes relatively slowly so that repeating the process at regular intervals does not add much. In practice, therefore, more useful screens are things like the new lows list on various markets that can be quickly and conveniently reviewed, since opportunities to buy at value prices usually arise from price declines. On the other hand, if screening is limited, say by industry or to large capitalization stocks, in order to produce a more manageable set of potential opportunities, experienced investors often find that they are already familiar with most of the names. Quantitative screening tends to be valuable more for novice investors than for veteran ones. Beyond specialization, Most value search strategies are commonly implemented informally. Start with industries in trouble, ones that appear disappointing, dispiriting, downtrodden. These are likely to trade at low multiples of value. Within industries, look for the same characteristics in firms, especially among smaller firms that are inaccessible to large investment funds and hence lack coverage by security analysts who need to get paid for their work. The company that has been doing the same thing for years, growing slowly and profiting modestly, is not going to spend its funds courting attention from analysts. A change in the fortunes of this kind of firm is more likely to go unnoticed than if it were doing something with a lot more flash. Undesirability has other signs. Companies in bankruptcy or suffering from severe financial distress are clearly undesirable, except to the knowledgeable investor who sees the real value of the assets and the business that may emerge after reorganization. And companies in industries that are suffering from overcapacity, a sudden increase in imports, general decline, or the threat of legislative or regulatory impairment may also be undesirable. Lawsuits, both current and potential, may make companies unattractive, and few things are more depressing than protracted underperformance. We're not referring here to a stock whose price drops by 50% in a week or even a day, but to one that has substantially lagged the market for 2 or 3 years. These indicators of undesirability identify potential areas of opportunity. As investors flee from bad news or poor performance, they discard stock at prices that may exaggerate the company's distress. Not always, of course. Sometimes things are worse than even the gloomiest analyst imagines, and the current low price of the stock is actually too high. But overreaction is frequent enough so that the informed and diligent investor may find bargains in the trash. There are securities that are mispriced because of institutional constraints or mandates and other temporary aberrations. When the Resolution Trust Company in the late 1980s and early 1990s disposed of assets it had acquired in taking over failed savings and loan companies, its aim was to get itself out of business and get these assets back onto the tax rolls. So investors who had the expertise and made the effort to value these assets, whether real estate, junk bonds, or the savings institutions themselves, were able to purchase them at sale prices. Though opportunities such as these are not everyday events, they happen with sufficient frequency to keep value investors attentive to the next opportunity. Finally, there are companies with divisions performing so poorly that the record of the whole company suffers. If the stock price reflects the earnings, often losses, of the whole company, then the only thing management need do to turn things around and boost the share price is kill the division. Most of these situations do not escape notice from the sharp eyes of Wall Street analysts, but there are always a few with situations that are novel or complicated enough to avoid detection. They await the value investor with the knowledge and time to disaggregate the company's results and spot the earnings potential. They require as well some catalyst to encourage the company's executives to rid themselves of the albatross and let the true value emerge. It doesn't always work out that way. We want to emphasize that all of this work is a starting point. The purpose of the search effort is to reduce the investment universe to a manageable size so that valuation analysis in depth can begin. The actual work of valuation and investment starts after the candidate opportunities have been selected, but a well-conceived search strategy plays an additional and essential role in the investment process. If, after careful analysis, an investment appears to be available at a large discount to intrinsic value, you always have to ask why. In a world of energetic, intelligent investors, this opportunity is being presented to you in particular. Why are you more likely to be on the right side of the trade? In the case of specialization, it is because you are particularly qualified to identify value. In the case of a broad value approach, it is because you have inoculated yourself against the behavioral and institutional biases that affect other investors. In both situations, the search strategy provides an important part of the case for any investment. 3. Valuation in principle, valuation in practice. Assets, earnings power, and growth, maybe. For a Graham and Dodd investor, valuation is naturally at the heart of the investment process. The same standard applies to a valuation process as to a search strategy. Is it better than the valuation practices being used by those on the other side of the trade? If Graham and Dodd valuations produce more accurate, better understood estimates of what you are getting for your money than widely used alternatives, then valuation is a second key step in the investment process in which value investors will have an advantage. Part of this advantage is rooted in the recognition that securities have intrinsic values determined by the fundamentals of the underlying businesses. In Graham and Dodd's time, much market activity was driven by speculation about how the trades of knowledgeable inside investors would influence future prices. Fundamental analysis of company operations was rare and applied largely to fixed income securities. Essentially, value was defined as tomorrow's security price, and market dynamics, technical analysis of a primitive type, were assumed to be the dominant factor in determining that price. As a prime mover behind the professionalization of security analysis, Benjamin Graham naturally assumed that his own attention to business fundamentals would give him a large advantage over the speculators on the other side of the trade. Even today, market-level technical and macro strategies, neither of which pays attention to specific company financials, still play a significant role in approaches to valuation and security selection. However, Graham's success has meant that attention to underlying business fundamentals is the rule rather than the exception. Yet there remain critical differences between fundamental analysis in the value tradition and much of what is being done today by people outside that tradition. One important difference is rooted in the time horizons of investors. Investors with short horizons, whether months, weeks, or even days, typically focus on changes in values, not on the level of those values. A large number of professional security analysts concentrate on forecasting changes in those business operating variables such as earnings, revenues, returns on investment, and product market shares, which are assumed to determine changes in the prices of securities. Because these are short-term forecasts, they generally take the existing levels of securities values as given by their market prices. If the analysts' forecasts are more optimistic than the market consensus, they anticipate that prices will rise in the short term and then buy the securities in question. If they are more pessimistic, they sell. From a Graham and Dodd perspective, this approach ignores vast amounts of pertinent information that would allow an assessment of the intrinsic value independent of the current market price, especially information related to a company's long-term prospects. If Mr. Market has temporarily inflated the price of a security, this will be neither recognized nor taken into account by short-term, forecast-driven valuations. For overvalued stocks, even optimistic forecasts that turn out to be accurate may produce disappointing returns if the starting price is too high. The opposite often holds true for undervalued stocks and pessimistic forecasts. Low purchase prices can produce positive returns, even if the company performance has not improved. Overlooking important information about the level of intrinsic value will put short-term investors at a significant disadvantage. Adherence to value investing as a discipline focus on measuring the intrinsic value of a security through careful analysis of business fundamentals from a long-term perspective. They believe opportunities for profitable investments are available when the current market price of a security deviates significantly from its intrinsic value. The essential task of the value analyst is to determine intrinsic value with enough accuracy to take advantage of the market's mispricing and to have the patience to wait for the market or some event, such as a takeover, to close the gap between price and value. This basic approach of comparing price to a fundamentally determined intrinsic value is far more widely practiced by investors than it was in Graham's time, including many who would not put themselves in the value camp. Competition for buying mispriced securities is significantly greater than in the past. But there are methods in abundance for estimating an asset's true value. We contend in this chapter that the Graham and Dodd approach, as it has been refined over the years by value practitioners such as Warren Buffett and others, remains superior to commonly used alternatives. The historical and likely future successes of a value approach arise from a superior valuation methodology, as well as a better search strategy. Common approaches to fundamental value measurement. Multiple valuations. The single most widely used approach to determining the value of a business's operation, and thereby the value of its securities, is a multiple valuation. A multiple valuation has two components. 1. Some measure of the distributable cash flow that is generated today by a business or security. 2. A ratio of value per dollar of this cash flow, the multiple, that an investor should pay to buy this cash flow from today forward. The product of the cash flow estimate and the multiple is a current estimate of the value of the business or security. The heart of a multiple approach is the selection of a measure of the distributable cash flow and the determination of the proper multiple to apply to that cash flow. In selecting a cash flow variable, analysts who have confidence in the accuracy of financial accounting take future net income to be an appropriate measure. Those concerned with the distorting impact of leverage and taxes use operating earnings, earnings before interest and taxes, or EBIT. Others who recognize that amortization of goodwill is often an accounting rather than a real cost add back amortization to produce EBITDA. Often analysts will apply the same logic, sometimes inappropriately, to depreciation and look at EBITDA, operating earnings plus depreciation and amortization. Analysts concerned that adding back depreciation ignores the investments required to maintain a business's capital assets and to support growth, money that is not available for distribution to owners, prefer free cash flow, usually defined as cash flows from operations minus investment spending. The multiple applied to any chosen measure of cash flow is generally determined by 1. Defining a set of comparison companies for whom the relationship of that cash flow to value should be comparable to the relationship for the target company being valued, and 2. Calculating an average ratio of market value to the cash flow variable in question for this set of comparables over an appropriately determined time period. The characteristics of the comparables will never exactly match those of the target company, so attempts are often made to adjust the multiple to account for any significant differences. Determination of an appropriate multiple will depend on the nature of a business's cash flows. Safe, stable, predictable cash flows should be more valuable than risky, unstable ones and should command higher multiples. Since stability and safety are impaired by high levels of debt, multiples should be lower for highly levered firms compared to those with little leverage. Better businesses with higher margins should have relatively higher multiples, both because they are likely to be safer and because they have better future business prospects. More generally, businesses whose cash flows are expected to improve in the future should have multiples above those of stagnant or declining businesses. This principle applies as well to businesses whose current cash flows are temporarily depressed by industry or economy-wide cycles. Their multiples may, in fact, appear elevated when they merely reflect investors' recognition that the cash flows will recover. Conversely, the cash flows of businesses operating at or near cyclical peaks should command lower multiples than they may currently exhibit. In all of these instances, the direction of changes in multiples are clear. Other business characteristics may have a more ambiguous impact on multiples. Good managements, for example, should enhance value per unit of cash flow. They will operate more carefully, lowering risk, and allocate retained earnings more effectively, enhancing future returns. Still, overall future business performance will depend on the quality of management in the future and how that compares to the people presently in charge. Here, careful reasoning produces counterintuitive conclusions. Firms with good management see that quality embedded in current cash flow measures. They are unlikely to get better. Firms with poor management, by contrast, have substantial room for improvement. Given these future prospects, it is bad managements that should command higher multiples, however obtuse that may initially seem. Making qualitative judgments about appropriate multiples in situations like those described before is only the initial step. Value estimates are necessarily quantitative, and multiples also must be quantitatively determined. A crucial part of this quantitative determination is the selection of the time period over which the average levels of market value to cash flow are calculated, especially when market multiples are inflated by excess optimism or lowered by excess pessimism. Current market multiples may be highly inaccurate. An alternative is to estimate average multiples using extended historical periods, e.g., periods encompassing 2 complete business cycles. But in changing business environments, these long-term averages may no longer be appropriate, and the resulting value estimates may be just as inaccurate as those based on current multiples. In practice, uncertainties in cash flow estimates and valuation multiples mean that plausibly computed multiple valuations may differ by as much as 100%. The net present value of current and future cash flows. Given the shortcomings of multiple valuations, the most common alternative is to use a net present value / discounted cash flow approach. In theory, the intrinsic value of any asset, whether an office building, a gold mine, a company selling groceries at the corner or over the internet, a government bond, or a share of Amazon stock, is determined by the present value of the disposable cash flows that the asset supplies to its owner. Net present value is properly calculated as the sum of present and future cash flows, both outlays and receipts, with each dollar of future cash flow appropriately discounted to take into account the time value of money. The term discounted cash flow, DCF, is used to describe the calculation. Graham and Dodd disciples accept the concept and the calculation of net present value, as do all other fundamental investors. The techniques are taught at every undergraduate and graduate school of business. Investment bankers and corporate financial officers use them. Governments depend on them to evaluate the returns from potential capital projects and other investments. Calculators are programmed to produce NPV figures, and electronic spreadsheets have financial functions that will do the work. NPV analysis is inescapable, but what is true in theory need not provide an appropriate model for measuring intrinsic value in actual practice. We can say, only partially in jest, that the practical value of NPV analysis should be discounted. The standard way of calculating NPVs, and hence intrinsic value, is to begin by estimating the relevant cash flows for the current and future years out to a reasonable date, perhaps 10 years in the future. Then one estimates, a rate for the cost of capital that is appropriate to the riskiness of the asset in question. The cost of capital determines the separate value per dollar of each future period's cash flow. Multiplying the estimated cash flows in each future year by these discount factors produces the values today, the present value of those future cash flows. The sum of the individual present values for the next 10 years is the present value of our foreseeable cash flows. The customary practice for dealing with the cash flows in the distant future is to come up with what is called a terminal value. The terminal value is invariably calculated by assuming that beyond year 10, or whatever year is the last for which we have done annual cash flow calculations, cash flow grows perpetually at a constant proportional rate. Under this assumption, the value of those cash flows, looking forward from the end of year 10, will be the projected cash flow for year 11 times a multiple. In theory, this multiple is equal to 1 divided by the difference between the cost of capital and the perpetual growth rate. For example, if we project a cost of capital of 10% and a growth rate of 5% a year, then the multiple is 1 divided by, open parenthesis, 10% minus 5%, close parenthesis, equals 20. In practice, any of the methods that we identified before for ratio valuations may be used to provide a multiple as either a supplement to or a substitute for this theoretical measure. Since we won't see this terminal value until we look forward from the end of year 10, we need to discount the terminal value back to the present. We add that to the NPV of our first 10 years of cash flows to get an intrinsic value for the current and all future cash flows. There is a serious inconsistency here between the precision of the algebra and the uncertainties infecting the variables that drive the model. We estimate rates of growth for the first 10 years, and then another growth rate from the end of year 10 to forever. This is a heroic, not to say foolhardy exercise. Suppose that in 2 or 3 years, the company faces more competition, technological challenges, a spike in its costs of materials that it cannot pass on to customers, or any of a host of reasonable possibilities that will curtail and may even eliminate the growth of its cash flow. Imagine how accurate our estimates are likely to be even for a stable company like Procter & Gamble or Pfizer, much less for dynamic firms like Netflix or Google. We also assume that our company will have access to long-term financing at a predictable cost of capital on an ongoing basis. Yet who knows today what lenders will demand in 5 years or how much potential equity investors will be willing to pay for new shares? Profit margins and required investment levels, which are the foundations for cash flow estimates, are equally hard to project accurately into the far distant future. Compounding the problem, valuations vary significantly if the underlying assumptions are off by only small amounts. Consider the terminal value and the cash flow multiple. If future perpetual growth is 4% and the future cost of capital is 8%, then the terminal value multiple is 25. 1 divided by, open parenthesis, 8% minus 4%, close parenthesis, equals 25. If our estimate is wrong by only 1% in either direction for the cost of capital and the growth rate, the terminal value multiple can vary from a high of 50, 7% cost of capital minus 5% growth rate, to a low of 16.7, 9% cost of capital less 3% growth rate. This is a range greater than 3 to 1, and in many, probably most, valuations, The terminal value is the dominant component of the total NPV. Investors are certainly aware of these difficulties, and there are ways of attempting to deal with them. One method, which certainly saves time and effort, is to simplify the valuation process by relying on multiple-based